The 10-year Treasury yield is headed over 5%. As of the time of this recording, the yield on the 10-year Treasury is 4.69%. You can see that outside of a short blip in 2023, this is the highest the 10-year yield has been going back all the way to August of 2007. If the 10-year does move just a tad bit higher to, let's say, 5.5%, we would have to go all the way back to November of 2000 since rates were that high. And technically speaking, looking at this chart pattern, it does look like a move much higher is coming very soon. Now, a 10-year yield above 5% is dangerous for the economy. Nearing 6%, potentially disastrous. But other than the chart, is there any reason why we should suspect that the yield on the 10-year would move higher? In other words, the price of 10-year bonds moving lower. Well, right now, the US government is having a really hard time issuing new treasuries. In fact, in its most recent treasury auction, it drew the highest yield since 2007. The US Treasury Department was trying to borrow more, around $39 billion more in a new auction, and ended up having to pay 4.68% on the new debt. Just in case you're unfamiliar with the way these auctions work, the government will say, hey, we are going to borrow a certain amount of money, in this case, $40 billion. If you and I, individuals, want to lend money to the US government as part of that auction, we will be purchasing a bond from them. It's like we're buying an IOU that gives them the cash, and in the future they give that cash back, and along the way they pay us interest. Now, before the auction starts, they're going to tell us what the interest rate will be on those new bonds. Individuals like you and I have no choice to try and get a different rate. We can either say, yes, we want to participate in the auction at the stated price, or no, we're going to wait on the sidelines. However, institutions do have the ability to ask for a higher interest rate. So once the auction starts, the US government is first, obviously, going to go to the people who agreed at the rate they want to borrow at. But increasingly frequently recently, there aren't enough dollars lined up at the rate the government wants to pay. So the government then has to turn their attention to everybody else, the institutions who want a higher interest rate. The government will then go in line borrowing from the people who want the lowest interest rate all the way up until they've satisfied their entire auction, in this case about $40 billion. Now, the key to note here is whatever the highest interest rate that the US government pays in the auction, that last person in line that gets that last dollar to the government, that interest rate actually gets awarded to everybody for the entire auction. And so when you see auctions where the US government is trying to borrow money and they have to pay more, it's a big deal. This can happen for a number of reasons. Number one, there could be inflation expectations, with most investors keeping their cash on the sidelines until they see an interest rate that is attractive enough that they feel will compensate themselves for their loss in purchasing power throughout the entire duration of the debt. The second reason this could be happening is just a lack of cash on the sidelines, a lack of cash available in the system. And given the fact that the reverse repo facility at the Federal Reserve is pretty much drained at this point, this is more likely than not the reason why auctions are going to start having to award higher and higher rates. And it's the reason why yields on 10-year treasuries are headed higher. Now, you might be sitting there thinking, well, reverse repo is short-term cash. That's overnight. It's not competing with something like a 10-year. And you're partly right. But for the past couple of years, the United States government has been able to borrow issuing T-bills for the majority of its debt. T-bills are debt instruments that mature in 1 year or less. They've been able to do this because at the peak, the reverse repo facility had $2.3 trillion in it. This was excess cash deposits in the banking system that had entered from all the spending, printing, borrowing that happened during 2020 and 2021. And so if the government wanted to access that cash in order to borrow it, they needed to borrow using short-term instruments like T-bills. They would need to pay a little bit higher rate than what was being offered in the reverse repo facility, but there was an endless supply of cash in there for them to draw on. But with this facility essentially hitting zero now, that liquidity is no longer in the system. So the government is forced to turn to the entire yield curve yet again to borrow from. This is why interest rates on things like the 10-year have been headed so much higher ever since the Fed started cutting rates, as well as the 20-year, as well as the 30-year. Now, by the way, guys, if you've been watching my videos for a while now and you've been looking for a way to profit from the ideas that we talk about here, I want you to save this date on your calendar. January 23rd at 7 p.m. Eastern Time. That's because I'm going to be hosting a free masterclass where I'll be covering one of the best kept secrets in all of finance: the asymmetric trade. These types of trades have been used for years by some of the brightest financial minds of our time. People like Big Short investor Michael Burry, Black Swan author Nassim Taleb, and billionaire hedge fund manager Bill Ackman. And I've personally used this strategy to take home some big returns in my own account over the last couple of years. And I plan on revealing everything I know at this event. We're gonna cover things like why I believe the next few months will present several massive opportunities to make asymmetric trades, and why I believe that if you want to profit from them, you need to get into position now. Number two, I'm gonna share with you a simple and easy to understand protocol that I follow for spotting these asymmetric trades. It's a system that has helped me take home massive gains in my personal account over the last couple of years and how you can use it in your own portfolio to shoot for massive returns. Number three, we'll cover the exact techniques that I've used to help a small group of beta testers spot some of their own asymmetric trades over the last few months. And finally, I'll show you how you can use these trades to profit from a quickly changing political environment. Again, this event is completely free, but spots are limited. In fact, last time I hosted one of these masterclasses, we had more people register for the event than could actually fit on the Zoom call. So if you're interested in attending, it's best to sign up now to secure your spot. And you can do that by clicking on the link in the description below. Now, this isn't just a problem for the United States government, it impacts everything in the economy because of crowding out. This is why we've seen mortgage rates continue to climb steadily higher, again, even though the Fed has been cutting. You see, government treasuries are viewed as the risk-free rate. In other words, I can lend my money to the US government and be reasonably assured that no matter what happens, I'm gonna get that money back plus interest. This means that if I want to lend my money to literally anybody else for any other reason, I'm gonna demand at least a little bit higher of an interest rate than the US government would pay me for the same time. Because individuals and corporations do not have the force of law. They cannot invade your home. They cannot take you to jail. They cannot force you at gunpoint to pay them. And so there carries some risk, at least some additional risk beyond what the US government has. Because at the end of the day, the one with the monopoly on violence always has the ability to go get the money they want to pay their debt back if they choose. Pushing this to its extreme, let's imagine that the US government was suddenly paying 20% on all of its debt. Then I, as a lender, am not going to lend out to you to buy a house with a mortgage for less than 20%. I'll probably demand 22, 25%, which means that you and everybody else who's trying to buy a home will not be able to get a mortgage for less than 20%. This essentially means that the rate that the US government is paying on its debt is the floor underneath interest rates across all other forms of borrowing. Now you might be thinking, well, what about the Federal Reserve? Because they have a lot of tricks up their sleeve, and you are absolutely right about that. One trick up their sleeve is balance sheet recomposition. Fed currently has about $6.8 trillion on its balance sheet, and you can think of this like their brokerage account. It's just an account that has a bunch of assets in it, and it's mortgage-backed securities and treasuries. The difference between their brokerage account and yours is that when they want to buy something to add it to their balance sheet, they just print the money. For you, you have to get the money in the account first by doing something productive. But the Fed's balance sheet is made up of all sorts of different treasuries that mature over all sorts of different time frames. This means that they can dynamically shift the composition of their balance sheet in order to help out the US government with their borrowing needs if there's any ever liquidity issues that are rising across the curve. To use a fitness example, a lot of people talk about body recomposition, body recomp. Essentially, it's where you would stand on the scale every day and your weight would not change. However, you would be losing fat and gaining muscle at the exact same time. And so you'd fit into your clothes better, you'd look better, you'd feel better, and you'd accomplish this by eating in a calorie maintenance state. So you're not holding on to additional calories, you're not losing additional calories, your weight is staying the same, the total amount of tissue you have doesn't change, but you're lifting weights and you're eating sufficient protein to build that muscle, which means that energy has to come from somewhere, and so your fat stores lose that energy in order to give your body the energy it needs since you're eating at a caloric maintenance level. Again, the weight stays the same, but the composition of your body that makes up that weight would change. This would be exactly what the Federal Reserve would be doing with its balance sheet. Its balance sheet would stay exactly the same at the current level of somewhere around $6.8 trillion. But they wouldn't be buying any additional treasuries. They wouldn't be selling any additional treasuries. They'd be making sure that the balance sheet stays exactly the same. However, what it holds inside of its balance sheet could drastically change. They could be selling a ton of T-bills and buying a ton of long-term bonds, or they could be doing the opposite, selling a ton of long-term bonds and buying a bunch of T-bills. This would be the same thing as you and your brokerage account. If you have all Apple stock in your account, you sell it all and you buy all Google stock in your account. The value, at least for the short term, didn't change at all, but what you hold inside of it did. But a trick like shifting the composition of their balance sheet can literally only go so far as they actually have the assets to do so. In other words, it's a temporary fix, not a long-term solution. And this is an issue because the higher rates go, the more capital gets sucked out of the productive economy. Higher rates will suck capital out of the productive economy for two reasons. Number one, it's the crowding out effect that we discussed earlier. If the risk-free rate is higher, then I'm going to give my money to the government instead of something else that can only afford a lower rate. And the higher the interest rate the government pays on its debt, the fewer people will be able to afford to borrow at those rates, which means all of the existing lenders will eventually direct all of their lending towards the US government, which is by definition non-productive and wealth draining. But this is a problem for a second reason, and that is that interest rates are the cost of money, or at least in a completely free market, that's what interest rates would be. The more expensive something is, that signals to the market that that thing is a lot more scarce than everything else. Therefore, when money gets more expensive, it incentivizes saving money and lending money. On the flip side, the cheaper something is, the more abundant that thing is relative to everything else. So when money gets cheap, it incentivizes spending it and borrowing it. In other words, in a free market, when interest rates are really high, that's really a signal to the economy that the savings pool is scarce, that everybody has spent their money, so everybody needs to be careful and start saving money. Don't take risks. Don't borrow. And that is exactly what is happening right now. The incentive is shifting for people to save more, to lend more, to borrow less and spend less, which obviously decreases economic activity. And if this were all happening because of strictly free market forces, there'd be nothing wrong with it. Those would be accurate signals sent to the economy that you should pay attention to. This is the US government who enjoys borrowing at the force of violence that it has a monopoly on. But at the end of the day, it still signals that there is a lack of liquidity, in other words, a lack of cash available in the system, which means anybody who does have dry powder will probably have the ability to take advantage of some pretty good deals as they come up with the incoming volatility that 2025 is set to bring. As always, thank you so much for watching. Have a great day.